Well, you're going to hear a lot of takes on this because the data is all over the place. And that's really what's to be expected right now. There are so many distortions around COVID. When you're trying to get a $20 trillion economy back on track, you're going to get data all over the place. And so what do we make of it? Retail sales has been really knocked around this year by the timing of stimulus checks. So March was revised even higher to just explosive sales because that's when we got the bulk of the latest round of stimulus checks. So naturally, you would have a payback of some of that in April. The sentiment numbers were down and people were clearly worried about inflation, and that was driving that. But what do we make of the inflation data? Well, this is to be expected that we were going to have this near-term surge. The jury is out on how far we come off of that surge in the subsequent prints. And then finally, in the jobs report, you had, on the one hand, weaker than expected job gains, which for all we know could be a one-off, but then higher employment costs or labor costs because, look, employers are having to pay up to get people back to work. And we've seen other data that's corroborated that. So there are just a lot of underlying distortions here that often point in different directions, but none of this, on balance, has me concerned about the viability of the outlook.
Yeah, and retail sales, while they were unchanged at what, a level above 10%? So we're clearly above 2019 levels. The retail stocks are up today. What about that confidence number, though, Ellen? Falling on rising inflation concerns. How's the Fed likely to look at a number like that?
Yeah, so the Fed balances all inflation expectations, but one distinction that they do make, which you can also see in the market-based measures as well, is that one-year inflation expectations or short-term inflation expectations have risen much more sharply than longer-term inflation expectations because households can see what's there right in front of them and what's coming around the corner, right? As I tried to get out to fly to see family this year, everyone else is going to try to do that too, and those airline prices are going to go up. And so they know that these higher prices are going to come. There's less confidence that the higher prices will stay over a longer period, but still those longer running inflation expectations have also risen. What the Fed does is they try to look at a holistic picture of inflation expectations, and they have a measure that they prefer called the common inflation expectations, which has 21 different measures of inflation expectations in it. Unfortunately, Sarah, it is a quarterly measure, and as you know, markets like higher frequency. The Fed doesn't operate at a higher frequency. And so right now, that inflation expectations measure that they like to follow is showing them that longer term inflation expectations are still pretty stable. So it's not yet cause for concern.
Ellen, what are the chances that the Fed doesn't mind if it does end up being a little bit behind the curve, given that the immediate reaction might be that the market pulls back, but that the economy doesn't, and they're willing just to play that game to make sure that they don't choke off the economy in the short term?
Well, it's a great point. I mean, last year, certainly we saw the markets disengage from the economy. And this year, what you could be seeing is just the exact opposite. And you can't have a Fed that reacts to every market movement, or you would have a Fed that is making high frequency, bad decisions on monetary policy. And so, when we get 1 week employment report, they can't react to that. They have to wait for more. And as we heard from Vice Chair Clarida this week, he's been disappointed in the economic data, which means that they're going, or on the labor market data, which means they're going to have to wait for more prints to come in to be sure that the trend is not accelerating. And most likely that delays how they're thinking about the tapering of their own balance sheet. When do they start taking their foot off the gas pedal? On inflation, you can say the opposite. The market's getting very excited and worried about inflation, but the Fed is not yet worried about inflation because, as you noted, they want to see inflation higher. They want to see it higher and sustained higher. And so far, things are moving in the direction that the Fed wants to see. The market is extrapolating just in some sort of linear fashion and saying, whoa, inflation is here and it's only going to get worse at the same rate. And that's really gotten markets jittery.
Shepard Smith here. Thanks for watching CNBC on YouTube.